There are 3 reasons you should borrow from your whole life insurance policy. My name is Darius.
And I'm Carmen. In this video, we are going to spill the tea because we want you to learn from us, cheers, on how to responsibly borrow from your whole life insurance policy because we've made a lot of mistakes. So let's go ahead and lay some groundworks. And that groundwork, you didn't put your pinky on, we need to put some respect on it. But the point is we want to lay some groundwork and we want you to understand the difference between an emergency and actually borrowing from the life insurance company.
Responsibly.
Yes, responsibly. So let's talk about an emergency first. An emergency is something where an expense comes up and you have to react quickly. You have to pay it back. And there is usually no repayment plan in place, right? So we're going to get used to that repayment plan in place. Those 3 words we're going to put on the screen all the time so that we can make sure we hit the point home. And Roger, our video editor, and Tanya, can you make sure that you put like bouncy balls on it? Like, let's make it like a children's show today. Okay?
Repayment plan in place.
Yeah, everybody say with me, repayment plan in place. Okay, so as emergencies come up, you want to make sure that you use your savings account for things that you need to react quickly on, right? When we think about borrowing from the insurance company using our policy as collateral, we want to have a repayment plan in place all the time, okay? So let's talk about an emergency. You want to talk about when you were sweating on the streets?
So yeah, a couple of days ago was had to be close to 1,000 degrees in DC, and we got a flat tire, and we didn't have AAA, we had Triple Darius, which is I had to put a donut on the tire on U Street in the middle of DC, and it was 1,000 degrees outside. Now that's an example of $1,000 emergency because I had to replace all 4 tires because that's the first time I replaced the tires. There was no plan in place to make that purchase. So that's what emergency fund is for. Because if I was to put on a credit card, we would have had to pay interest on that emergency.
Mm-hmm. Now, this actually segues to the very first point, right?
Yes.
So the very first point that we believe that you can borrow from the insurance company using your policy as collateral is to pay off high interest debt. The reason being is because there is a repayment plan in place, right? When you pay your minimum payments every single month on your personal loans, credit card debts, car loans, whatever it is, you are paying every single month a repayment plan. And a lot of times the bank, or not a lot of times, the bank already does all the heavy lifting for you. So you know how much you're paying every month, you know what the interest is, and you know what your balance is. So you can literally copy and paste that same formula over at the life insurance company, and you can borrow from the insurance company so that you can pay off your debt. However, you are going to continue to make those monthly payments back to the life insurance company. Let's walk you through some numbers.
Right. And this is important because the insurance company isn't going to tell you what you need to pay every single month. They're just going to send you a bill on your anniversary for how much interest you owe. So we want to take the lessons learned from the plan that the bank give us, and we want to apply it to our own life insurance policy, a life insurance company, so that we can make those payments back. An example of this is our Amazon card. We had an Amazon card where our balance was $3,394, and Amazon said that your interest is 26% interest on this debt. That's $105 that we are expecting you to pay every single month for the next 57 months. Amazon gave us a plan. So in order for us to be responsible with our debt, what we did is we borrowed from our life insurance company. We paid off this debt. And for the next 57 months, we made $105 payments back to the insurance company. Now, what that allowed us to do is, instead of paying the principal and interest to Amazon, we ended up paying that principal and interest back to our insurance company, which was $5,984 for a $3,394 debt. That's the difference of $2,591 that we were able to use to buy additional life insurance for ourselves.
Mm-hmm. Now, the point about this is, remember the $2,500 that Darius said that is basically profit. That's what we would have paid to the banks. Or in this case, we're going to take the $2,500 and we are going to use that to buy more premium, what we consider additional paid up additions, because we're going to pay the balance, the $3,300 balance, back to the insurance company company, right? We're all done plus whatever interest that we owe, right? And then the delta, the difference or the cream on the top is what we're going to put towards additional paid up additions that help grow our policy. Now, let's talk about that interest that the life insurance company is going to charge us, right? So I know you guys are going to ask in the comments. With this particular transaction, the insurance company charged us 5% simple interest. And if you do 5% times $3,394, you're going to get $169 and some change. So let's call it $170. So that means a year from when we borrow that money, we are going to pay $170. However, things change slightly in this transaction because we are making payments on that balance every single month. So we are actually reducing the overall cost of the insurance the overall cost of the interest that the insurance company is charging us. So we think about 57 months being a little over 4 years or closer to 5 years. That balance is actually going to be significantly reduced year after year because we're paying more on the principal balance.
So now you can see how you can leverage your life insurance policy to get a loan from the insurance company and buy your debt from Amazon or from Wells Fargo, whoever you have your high interest debt with. We take the plan that they already established for us and we just use that same plan to give the money to the insurance company so that we have more cash value and more life insurance in the future.
Absolutely. So let's jump into point number 2, how you should responsibly use the cash value in your policy, which is through investing. This is one of our favorite options because we know that investing means we're bringing back friends, meaning money with more money.
Yeah, instead of paying interest, we're trying to earn interest now.
We're earning interest. So the example that we want to share with you is an investment that we did where we actually borrowed from the insurance company $25,000 for an investment that we knew was going to be outstanding for 2 years. Now, we actually had a really phenomenal opportunity where we were able to earn 30% on this investment. Now, what we knew going into this was we aren't making payments to the insurance company every single month because of the way this transaction was happening. We knew that at the end of 2 years, there was going to be a payout, and that payout was going to then pay the principal balance of the $25,000 plus the interest owed. Right? There was a payment plan in place. Now, the reason why I want to be clear in sharing this information is because we have to understand when we're borrowing money, especially with through the life insurance companies, that they provide us a level of flexibility so that we can actually transact the financial business that we need to in the manner in which we need to, where they're not expecting monthly payments, right? In this case, we knew that the loan was going to be outstanding for a few years and that we did the numbers to ensure that the return we were getting from the investment, the 30%, would cover the principal and the interest owed to the insurance company.
Right. Now, here's another thing that I want everybody to take in consideration as to why we're paying interest to the insurance company or why they're charging us interest in the first place is because the money that we're borrowing is coming from a pool of funds that the insurance company was using to make investments of their own. So if they give us the money, if they let us borrow the money, that's money that's no longer in operation for them to earn money. So they have to charge us interest for borrowing their money. We're not borrowing money from our personal life insurance policy. We're borrowing money from the insurance company. The fact that we have a life insurance policy that has cash value that's accumulated is the reason why we're able to borrow from the life insurance company in the first place. So because they lent us that money and that money is no longer able to use to make money for them, we have to pay interest. But what we've done in these first two examples is we've used those funds that we've borrowed, and because there was a plan already established in place, we use the interest that we either would have paid on the credit card to pay the insurance company back plus interest, and the additional funds we were able to buy more life insurance and cash value. The second example, we use the money from our investment, the interest that we earn from our investment, to pay off the loan and the interest to the insurance company, and the difference we were able to buy more life insurance and cash value.
All right, so let's put numbers on the screen so you can follow along with the numbers so you can see how this investment made sense for us. $25,000 at 30% return, that equals $7,500. That was our profit, right? So when we think about what it cost us to get a loan for, $25,000 times 5%, that's $1,250. times that by 2 years, right? Because we had the loan outstanding for 2 years. That means it cost us $2,500 to have an outstanding loan at the life insurance company. Now, knowing this information, Darius and I looked at ourselves and we said, okay, knowing the cost is $2,500, we're going to pocket $7,500. Does this make sense?
Yes.
Which means we profited $4,000, right? Because we paid $2,500, the principal balance to the insurance company, and then we paid them 2 years worth of interest. And the rest, like Darius said, we put towards paid up additions in our policy so that we can purchase more life insurance, more cash value.
Now, the third reason you want to use your whole life insurance policy is to borrow for retirement. The reason why this is important because, again, there's a plan in place and you've worked up until this point to make sure that you have funds available by using your policy to pay off debt, by using your policy to make sound investments, and you've accumulated these funds to now where you can borrow money to take care of your retirement needs.
Mm-hmm. Now, this makes it super simple. Depending on how much you are paying for your premium every single year, the idea is understanding in the latter years of your policy how much your cash value growth is going to be every single year, because that is going to be what is available to you to loan so that you can use this for income. And again, this is income that is not correlated to the market, right? So depending, no matter what is happening in the stock market, you know that you have some access to cash.
And you don't have to pay any taxes on money that you borrow from your life insurance policy. So that's another opportunity you have where you can still continue to get all the benefits that you have with the other things and also be able to take advantage of your whole life insurance policy.
Mm-hmm. Now, this is a little teaser. We have all of the numerical breakdowns in our course called the Lifestyle Ownership Course. So if you're interested, go ahead and click on the link below. Click on the link where it says I want more education. And the idea is you will be able to have access to 7 videos where we break down all of the numbers and how long it took to accomplish our financial goals using life insurance. So for this example, we're going to say that you pay $20,000 every single year in premium to your life insurance policy starting at the age of 40. Well, fast forward to the age of 67, you will be able to have access to $40,000 a year in additional income aside from everything else that you got going on that you can access to pool for retirement income.
Now, this is how much money we have access to. Your numbers are going to be different from ours, but just for this example, we're just sharing with the policy that we currently have in place. When we're at the age of 67, we have about $894,000 just in cash value. Mm-hmm. Now, we're going to use those funds for our retirement needs, and we're going to have the ability to pull out $40,000 every single year from our life insurance policy and still be able to leave $1,017,911 to our beneficiary.
And this is also just with one policy. Darius and I both have multiple policies. So the idea is we like to accumulate multiple assets in the form of whole life insurance now and as we continue to live, because we know our need for income protection is going to be there and also our need to improve our family's legacy. So just using this one example, right, of being able to fund a policy, we are going to have access to over $800,000 of cash value that we can use at our discretion, and we can use that for retirement income should we need to.
Right. And one thing I want to say about this is just the life insurance policy by itself. This doesn't take in consideration all the assets that we've accumulated using our life insurance policy up until the age of 67. Mm-hmm. So really take this into consideration, how by leveraging life insurance and being responsible and having a plan in place that you can do multiple things and really have things kind of add up and accumulate to your benefit for your financial security in the future.
Because the thing that you want to consider is the only way you can grow your policies is by 3 activities: paying your premium, by the dividend payouts, and then also it's premium, going back to premium, but contributing to the additional paid up additions. Like we said, the other interest, the cream that we get from these investments is we take that and we put it back in premium, also known as additional paid up additions. So anytime you're sending money back to the insurance company, usually that's going to help you grow your policy. So that's what we do with our policies, and we hope that this has given you some insight on how to responsibly use the cash value inside of your whole life insurance policy and distinguishing the difference between an emergency and a what? Prepayment plan. All right, Wealth Nation.
If you want to learn additional ways on how you can use your whole life insurance policy, then check out our next video.
And make sure to own your own lifestyle.
Or someone else will.